Imagine walking into a dealership thinking you can afford a $700 car payment, only to drive home with a $1,000 payment because the salesperson made the monthly number look manageable. That extra $300 might not sound life-changing at first, but over a 5-year loan, it represents $18,000 in payments. And that's before insurance, gas, maintenance, registration, and repairs. The scary part is that a $1,000 car payment is no longer some unbelievable outlier. In 2026, Experian reports that the average monthly payment on a new vehicle is about $770, while used car payments average roughly $531. So when someone agrees to a $1,000 payment, they aren't just buying a car. They may be committing a huge portion of their future income to one rapidly depreciating asset. And that is where the car payment trap begins. Here's how it usually happens. You find a car you really like and the sticker price looks intimidating. Maybe it's $45,000 or $50,000. You tell yourself, there's no way I'm paying that much. Then the salesperson asks a different question. What monthly payment would you be comfortable with? Suddenly, the conversation shifts away from the actual price of the vehicle and toward a number that feels easier to handle. Maybe you hear, we can get you close to $900. The problem is that your monthly payment doesn't tell you how expensive the loan really is. The payment is controlled by 3 major variables: how much you borrow, your interest rate, and how long you take to repay it. Stretch the loan longer, and the monthly payment can fall while the total amount you pay rises. This is why a lower monthly payment isn't automatically a better deal. Imagine borrowing $40,000 at an interest rate around 6.4% for 5 years. Your payment would be roughly $780 a month. Now imagine stretching that same debt over a much longer period. The payment can become easier to swallow, but you're keeping the debt around for more years and giving interest more time to accumulate. Experian's Cone 2026 data puts the average new car loan rate at about 6.39%, while used car loans averaged around 11.43%. That difference matters because interest isn't just a technical number buried in your contract. It is the price you're paying for borrowing someone else's money. And here's another problem people often miss. The car payment isn't the real cost of owning the car. Suppose your loan payment is $850 a month. Add $200 for insurance, another $150 for gas, and perhaps an average of $100 for maintenance and registration over time. Suddenly, your $850 car isn't really an $850 car. It's costing you around $1,300 a month to keep it on the road. That's $15,600 every year. And if your income isn't growing faster than your expenses, that vehicle can quietly become one of the biggest obstacles between you and your financial goals. Think about what that $1,000 monthly commitment could compete with. It could be money going toward an emergency fund. It could be extra payments toward high-interest credit card debt. It could be contributions to a 401(k) or an IRA. It could be money you keep available for a job transition, a home down payment, or an unexpected medical or family expense. This doesn't mean buying an expensive car automatically makes someone financially irresponsible. If someone has a high income, substantial savings, low debt, and a strong financial cushion, they may be able to comfortably afford a larger payment. The problem is when the car payment looks affordable only because the loan has been stretched to make the monthly number smaller. One of the biggest warning signs is when you need an extremely long loan term just to make the payment fit your budget. If the only way you can afford the vehicle is by financing it for years and years, that may be a signal that the vehicle itself is too expensive for your current financial position. And there's another risk: depreciation. Your car can lose value while your loan balance remains high. If you owe more than the vehicle is worth, you're in negative equity. That can become especially painful if you want to sell or trade the car before the loan is paid off. Rolling negative equity into another vehicle can increase the new loan balance and potentially put you upside down all over again. So how do you avoid getting trapped? Start by reversing the way you shop for a car. Don't begin with the question, how much can I pay every month? Begin with, how much vehicle can I reasonably afford without damaging the rest of my financial plan? Set your maximum total vehicle budget before you walk into a dealership. Then look at the purchase price, loan amount, interest rate, loan term, taxes, fees, insurance, fuel, and maintenance. The goal isn't to find the largest payment a lender will approve. The goal is to find a vehicle that leaves enough room in your budget to continue building financial security. Your credit score can also make a major difference. Lenders generally use your credit history and other financial information to determine the rate you're offered. A stronger credit profile can potentially help you qualify for better financing terms, although approval and rates vary by lender. Before shopping, check your credit reports for inaccurate information and understand where your credit stands. Experian notes that consumers can review their credit information and dispute inaccuracies for free. But don't make the mistake of obsessing over your FICO score while ignoring the size of the loan itself. A great credit score doesn't make an unaffordable car affordable. You should also shop for the financing separately whenever possible. Don't assume the dealership automatically has the best loan available. Compare offers, look at the APR, understand the loan term, and calculate the total amount you'll repay. Experian specifically recommends comparing multiple loan offers because interest rates can vary between lenders. And when you're sitting in the finance office, pay attention to optional products and fees. Add-ons can increase the amount you're financing, which means you're potentially paying interest on those extras too. There's also a psychological trick worth understanding. Cars are emotional purchases. You imagine yourself driving the vehicle, picture how it looks in your driveway, and start thinking about all the reasons you deserve it. That's exactly when you need to slow down. A salesperson may be focused on closing the deal, but you are the person who has to make the payment every month after the excitement of the purchase disappears. If you feel pressure to make a decision immediately, walking away can be one of the smartest financial moves you make. A car is replaceable. Your money and future financial flexibility are much harder to replace. And remember, the goal isn't necessarily to buy the cheapest car you can find. It's to buy a reliable vehicle that fits your life without dominating your finances. Sometimes that means buying used. Sometimes it means buying a less expensive new vehicle. Sometimes it means keeping the car you already own for a few more years. And sometimes the smartest financial decision is simply waiting until your income, savings, or credit position improves. There is no prize for having the most expensive car in the parking lot. The biggest lesson is simple. Don't let a monthly payment make the decision for you. A $1,000 payment doesn't exist in isolation. It represents a loan, interest, depreciation, insurance, fuel, maintenance, and years of future income committed to one vehicle. Before you sign anything, calculate the total cost, compare financing options, understand the loan term, and ask yourself one uncomfortable question. If my income dropped tomorrow, would this car still be affordable? If the answer is no, the car probably isn't affordable today. The best car isn't the one that makes you look richer. It's the one that gets you where you need to go while still leaving enough money behind to build actual wealth. Because financial freedom isn't about being able to make a huge payment. It's about having enough financial flexibility that you don't have to